Well, stocks rallied to fresh record highs last week, while the long end of the Treasury curve gained ground as well, even as the dollar meandered after the cooler than expected PPI data and inline CPI data cemented the case for a September rate cut from the FOMC this week, and while the ECB stood pat as expected. Moving on to this week, it is a monster of a week for financial markets. The FOMC on Wednesday highlighting proceedings, but we've got 4 other G10 central bank decisions in the mix as well, plus a data deluge from here in the UK and elsewhere in developed markets too. So plenty for us to discuss on the trade-off this week. Without further ado, let's crack on with the show. So it was an intriguing week for markets last week, and a really busy and hectic week looks like it lies in wait for us this week. Joining me, as always, to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. And Ryan, I assume you'll be leaving us 2/3 of the way through proceedings, because that seems to be what West Ham fans do these days.
I don't care, mate. I was in the pub at 11:30 in anticipation of it all going wrong, and I don't remember much after that. So I don't know what happened. I'm a happy bunny.
Well, as long as you haven't been in the pub since 11:30 today, then we should be all right, I hope.
Well, sometimes to listen to you need to be.
Oh, well, blimey. Well, we'll move very swiftly on from that one then, shall we? And get on to topical fun. Right, where the hell do we start this week? We may as well start with the FOMC, because I think that is probably the main event of the week, although there are probably about 15 different things that we could call the main event, such as the number of catalysts that we've got this week. But we are, of course, expecting the FOMC to resume their easing cycle on Wednesday evening, of course, having been on pause since December. The labour market showing signs of stalling and losing momentum, and the Fed increasingly viewing the pass-through of tariffs as a one-off shift in the price level. It sets us up for a 25 basis point cut on Wednesday night, lowering the target range for the Fed funds rate to between 4 and 4.25%. I do think, though, that there is, well, almost certainly going to be a dovish descent, if not more than one. The prime candidate for that, of course, being CEA chair and incoming governor Steve Moran, but possibly Chris Waller and or Mickey Bowman as well, voting for a 50 basis point cut. There's also the potential for a descent on the other side of the coin, potentially voting for rates to remain unchanged. Alberto Musalem and Jeffrey Schmidt, who are the regional presidents, have sounded relatively hawkish of late, so it wouldn't be a complete surprise if they actually dissented in the opposite direction. In terms of the guidance and the policy statement, I think they're going to stick with a data-dependent approach, but there is a potential that the statement changes from additional adjustments to the Fed funds rate to rephrase that as additional reductions in the Fed funds rate, just to firm up that easing bias. I think where it gets interesting, though, and this is probably what we should dig into, is the dot plot and the updated SEP, because I think we're going to see the dot for this year, the median expectation, remain at a total of 50 basis points worth of cuts. It would take 8 policymakers moving their dot lower to shift that median, which is quite a high bar. But the current median for 2026 only points to one 25 basis point cut. It only needs one member to move on that front for the median to then start moving lower as well. So I think the dots are going to be keenly focused on by market participants. And then, of course, so will Fed Chair Powell's press conference. But I don't think we're going to get anything explicit in terms of timing of the next rate cut from Jay Powell on that front. I know we were discussing this actually earlier in your chat room, Ryan, but I think it's important to view the FOMC through the lens that the market is viewing it through, and that is a market that prices 70 basis points worth of cuts by the end of this year. That's a very dovish angle, a very dovish way of looking at things that the market is adopting at this moment in time. And I think in that sort of context, almost anything the FOMC do will be interpreted as hawkish relative to where the market is priced, which is 70 basis points of easing by this year, and we're back at the terminal rate of 3% by next July. That is a very aggressive easing path. And while it's something that the Fed might well end up delivering, I think them explicitly endorsing that right now, that feels a bit implausible to me.
Well, where do we start with this one? Yes, I get your point. But it's, look at how things develop. Before we came into August, we've been sitting on the show here saying, when are the Fed going to cut? How can they cut or even look to cut with the data the way it was? We've had two wobbly jobs reports. We've had Powell then at Jackson Hole pushing the focus onto the labour market. And here we are now pricing 2/3 cuts for the rest of the year. The Fed have pretty much always been at 2 cuts for this year. So whether they cut twice, cut 3 times, it's largely irrelevant. It's not going to make a huge amount of difference. But this meeting is important as I've been saying, beginning of September, for the rest of the year and going into next year, because it's going to set the standard for markets on how they trade going into next year. I think, if they cut twice this year, then they're going to cut 3 times next year. If they cut 3 times this year, they'll probably only indicate 2 cuts next year. I think this 3% level that the market sort of coming around to as the soft landing place for rates next year, I think the Fed's going to go there, but it's all going to come down to, do they match what the market's going to expect for next year, or are they going to be a little bit more dovish or a little less dovish? And that's what's going to get the final pricing going into and over the Fed. So it's from here. I'm in that camp as well. 3% next year, and let's see what the Fed say from the dots.
Yeah, I think you're right, and I think the other thing we've got to consider, is this is a meeting where a cut is so well telegraphed and it is so well priced in that it could end up potentially being a bit of a buy the rumour, sell the fact situation when it comes to equities. And I just wonder whether that is the trigger for us to enter this sort of period of relatively weak seasonality into the end of the month and into the end of the quarter. The end of September, start of October is typically not the best time for risk. So potentially the FOMC just sort of tips us over the edge a little bit, even though I do believe in the longer run bull case for the stock market.
Yeah, I mean, I know you're trying to push my buttons straight in the seasonality after the discussion we just had 5 minutes ago.
You weren't rising to it.
Yeah, no, I'm not biting. There's one reason why you get these seasonal moves around this time is because we've come out of summer into a period where there's a big change sometimes to the central bank. As I say, I said it when we came back, the first trader for the September, it's going to be a big month. It's going to be a huge month because it means what's going to happen in the future, not what happens in the next 2 or 3 days. People are going to be looking at the stock market in terms of whether it's going to be a buy rumour, sell fact. I'm going to look at 10-year yields because for me, as I always sound here, they give me the clearest picture idea of what the market is looking at in terms of rates. The bond market is the biggest market, so it tends to give you a much slower, clearer picture of what's going on. And pre-summer or pre-Jackson Hole, we were looking at this range in 10s, 420 to 450. We broke below that 420 mark. We've been down to the 4% mark. So for me, it's a question, when we finish up with the Fed afterwards, where are these yields going to be in 10s? Are they going to be below 4%, indicating we have had a much more dovish shift from the Fed, or are we going to stay above 4% and maybe just building a lower range between there and 420? So, this will be my buy rumour, sell indicator for that.
No head and shoulders pattern in that 10-year chart anyway?
None at all. The only reason there's moving averages on it is because I've got to take them off. We don't do checks on yields.
Right, I'll stop throwing bait out now. There are many more central banks other than the Fed this week. Ryan, why don't you take us through?
Yeah, we've got quite a few. Tons of central bank action, really. We've got, before the Fed, we've got the Bank of Canada. They're also expected to cut by 25 pips to 2.5%. Now, that expectation has ramped up pretty quickly, a bit like the Fed. Mid-August, we were only pricing a 37% probability chance of a cut this month. Now we're at 87%. In a similar vein to the Fed, the jobs market over there has sort of deteriorated maybe a bit more severely than we've seen in the US, with the unemployment rate up to 7.1%. Inflation has been trending sideways around 1.7%. That's just a smidge below their midpoint of their 1 to 3% range, though the core does remain a bit stickier. And on Tuesday, that core is expected to post its 4th month at 2.6%. Now, the consumer did bounce back at the start of summer with a 1.9% gain in June, and that was following 3 negative prints. And I think, therefore, a cut is probably justified, at least on the jobs market, as the decision to hold last month was pretty close, and that labour market weakness since that last meeting has probably sealed the deal for those guys. Now, I know Michael's going to talk in more detail about the Bank of England, but I'll leave that. And we have the Norges Bank also on Thursday. This one could be a bit closer. They're expected to cut 25 pips to 4%, but I'm not sure if the decision is going to be as clear cut as what the market may be looking at. They have been indicating that they expect to cut maybe once or twice in the rest of the year, but they held rates at their last meeting, or their last 2 meetings, citing sticky inflation still above target. And since that last August meeting, CPI has been stuck at 3.1%, and their core has been stuck at 3.1%, and the headline has actually gone up to 3.5 from 3.3. They also did see a little blip up in their unemployment rate a couple of reports ago, but that was due to a big jump in the participation rate. That's then come down again. So jobs-wise, they're still looking no good. So I think overall, just looking at those 2 metrics, the data for the Norges Bank would suggest that they might stay on hold rather than cut rates. But that's going to be an open one. I know lots of people are going to be trading the knock in our chat room. And then to finish the week, I need a breath of fresh air there. We've got the Bank of Japan, who, as we've been discussing here last week, they're creeping towards another hike. And, stories have suggested that they may look through the political goings on and pull out a rate hike by the end of the year. Although this week's meeting has been ruled out for a potential hike, probably due to that leadership election coming the 4th of October, we should expect some further sources pieces out of Japan, maybe indicating when they're going to be penciling in a cut. But I still wouldn't rule out a cut from them this week, because sometimes they like to pull a surprise, but it's a very low probability in my opinion. And got to finish it off. The SARB, South African Central Bank, are also reporting on Thursday, expected to keep rates unchanged at 7%. I need to do a thorough job, Michael. You know that.
I was just saying, you mentioning that for a bet or something? Like, where did that one come from? How far into emerging markets are we going with our coverage these days? There's a hell of a lot going on this week. I think that was a brilliant summary of everything that's going on. The BOJ, it looks like, well, if you believe the Bloomie and the Reuters sources that were doing the rounds last week, maybe October's when they start to look at things again in terms of pulling the trigger on another hike, but they'll probably have found another excuse by then to hold rates steady anyway and delay that once more. I think really as the Fed is obviously going to overshadow things, but the one thing I would say is as a result of that, if you are looking to express a view on, for example, the Norges Bank decision or the Bank of Canada decision, whatever it may be, it might be worth considering looking at some of the crosses, like Euro NOK instead of dollar NOK, for example, just to take out some of the noise, some of the choppiness that we will almost inevitably see during, but also after that FOMC decision on Wednesday evening. So if you are looking to trade or you've got positions of risk to manage over these events, it may be worth considering just taking the dollar side out of the equation if you want a little bit of an easier ride, I suppose.
Yeah, it's easier ride as you can get in these markets at the moment. So, yeah, take what you can get.
Yeah, absolutely. Speaking of bumpy rides, let's move on to the UK. I've said here in my notes that it's the calm before the storm today here in the UK, but actually it's not. If you look at cable, we're trading, or we were momentarily earlier on, north of 136 for the first time since July, I believe. So, clearly Rachel Reeves' economic acumen is paying dividend. No, it's not that. It's the fact that the dollar's just broadly weak. In terms of the week ahead, though, it is a busy one. We've got a lot going on here in Blighty this week. It will be out by the time you watch this show, I believe, but we do have on Tuesday morning the latest labour market data. Still concerns over how accurate that is or isn't, but nonetheless, we are expecting unemployment to have held steady at 4.7% in July, earnings growth to be around that 5% mark once more, which is clearly incompatible with the Bank of England's 2% inflation inflation target. On that note, we have inflation data due on Wednesday. Headline CPI is seen having held steady at 3.8% on an annual basis in August. Of course, the BOE expecting that to peak at 4% in September. And I think that is really the most important date in the diary for the UK over the next sort of 6 weeks or so is the 22nd of October. That's when we get the September CPI numbers. That if the number comes in at or below where the BOE think it will peak, there's a chance of another cut in November. If it's above 4%, then you can probably kiss goodbye to any rate cuts before the year is out. On that note, we hear from the BOE on Thursday. The latest MPC decision is due. It is worth noting that the MPC will have advanced sight of both the inflation and labour market reports by the time they vote on Wednesday evening, and that announcement comes on Thursday lunchtime. Bank rate likely to be held steady at 4%, although the vote is likely to be 7-2, with two dovish dissenters favouring a 25 basis point cut, probably external members Dingra and Taylor. Meanwhile, the MPC likely to repeat their gradual and careful guidance in terms of future rate cuts, but it's really the balance sheet that's going to be in focus this time around. As always, the September meeting is when the BOE will do their annual review into quantitative tightening. For the last 3 years, they've let 100 billion quid a year run off their balance sheet in terms of their gilt holdings, likely to slow the pace of that. I think consensus sees the envelope at somewhere between 60 and 70 billion pounds over the next 12 months. About 50 billion of that will be passive, i.e. gilts maturing and no new gilts being bought to replenish that portfolio. And then the balance will be active sales, with those sales tilted to the front end of the curve in order to try and alleviate some of the pressure that we've seen on long end yields recently. And then if that wasn't enough, Friday, bright and early, 7 a.m, as always with UK data, while Ryan is tucked up fast asleep, we have not only the August retail sales report, where sales are expected to have risen by 0.4%, decent weather over the summer should help that, but also the latest public borrowing stats, where we're expecting a deficit just shy of 13 billion in the month of August, which by my maths of eyeballing a chart yesterday will be the third highest August on record when you take out the pandemic period. And clearly that is yet more bad news. The Treasury ahead of the budget at the end of November. So of course we come into this with cable trading just north of the 136 figure. Feels a bit rich, doesn't it?
Yes and no. Both you and I
are nice and clear as ever. Let's move on.
Well, you trade across multiple time horizons. Both you and I know that there's pain coming later in the year. It's probably going to happen after the budget, on the budget. But in the meantime, the data largely has been holding up. We've not seen a massive collapse in the jobs market. We've seen the PMIs improving. We know summer has been a consumer-led positivity run, shall we say. I've been expecting August numbers to post decent gains in the retail sales. I expect they're probably going to fall off a cliff when we get the September numbers. And that's probably when we're going to start seeing the pound suffering again, when everyone knows that this has just been held up by the holidays, really, and everyone down in tools and going down the pub or whatever. But for the Bank of England, I'm in the same line of 7-2, maybe a 6-3. And we were pretty spot on at the last meeting saying it was going to be a much closer one. So I think there's no reason for them to change it. What's going to happen with the pound though? And where, yes, it may be doing all right today, but if those jobs numbers and CPI data are, far worse, much lower, the market is going to react to that and, maybe think, it could be a tighter decision on Thursday. And failing that, then, yes, cuts are going to be priced in for the future months. So, the pound's all right at the moment. Whether the pound's all right come Friday afternoon is going to be another question.
Yeah, I think you're right. I mean, let's hope the bank only have to vote once this time. August obviously was rather shambolic, where you're almost accidentally leaving rates on hold because someone wants to deliver a bigger rate cut. Let's consign that to the history books. I do think it'll be interesting to see how the market reacts on that inflation number if we do get a hotter than expected number, because the textbook reaction is, hotter than expected inflation, hawkish repricing of policy expectations, stronger currency, and higher yields as a result. But in the UK right now, if you do see that hawkish repricing expectation, if you do see a sell-off across the gilt curve, well, that's just piling more pressure on the fiscal side of things. In my view, piling more downside risks onto the economy as well. So I do still think there's a risk that traditional correlation between higher government yields and the currency is effectively broken here in the UK at the moment, given the fiscal situation. But as you say, we will see how that shakes out throughout the week. And I know that's what you want to look at now. And you're about to deliver the understatement of 2025 with your first line.
Oh, well, I'll have to see what you're pointing out in that one. This week has the potential to be quite volatile. Is that the understatement you're looking for? Yeah, but I also don't want to give it the kiss of death because, as traders, we love a bit of volatility. So I really want to speak about how traders can make sure you're keeping an eye on the bigger picture amid all this intraday volatility that we're going to get this week. As I said, I mentioned on the trade-off beginning of the month regarding the Fed. We're in week 2 now of 2 huge weeks I said was coming. The first was finding out what the data was going to do, the jobs market, the inflation data. And because we're not just trading the now, we are trading the future. So where the market has settled in terms this week is what we need to know for trading over the rest of the year and into 2026. So once we know the Fed's path on Wednesday, the market from that point, they'll have a last minute readjustment, but then we'll just be trading the small changes in rate expectations via the data that may cause them to, step off that path that they see fit in either direction. And it will be small changes, just like we have been doing in the early part of the year. Are they going to cut twice for the rest of the year? Are they going to cut 3 times for the rest of the year, or once, or that sort of thing? So that's the small moves we'll be dealing with probably till December when we get the next forecast and we get to see how the economies perform from there. So for markets themselves, we do remain in some well-worn ranges, with the odd exception like the pound today, Aussie dollar, Mexican peso. They're looking to make breaks of big ranges and levels. So this week will be about where we are at the end, irrespective of what happens in the middle. Which brings me to dollar yen, and this was my play of the day last week. I was looking to sell rallies however they came. I started getting into shorts just after that jobs revision, that negative 911,000. That was a bit of a FOMO chase trade because I was getting the itch to be short. Then we had PPI and CPI data, and really that had me running from pillar to post because the dollar moved completely in the opposite way to how it should have done over that data. It dipped initially on that big downside miss for PPI, then rallied right back. And then when we got that sticky CPI and you think it would have rallied, it went the other way. So at one point after that CPI was at a complete loss as to what was going on. But in the meantime, dollar yen went back and forth in the range 146.80s, 148.80s. It did have a little bit of a blip below that. I can tell you I had to work hard for my money in this pair last week because I was short down the bottom, short in the middle, a bit short up top, working to try and take some profit.
Short up top for a long time.
Oh, well, I set you up for that one, didn't I? So yeah,
I can't talk, but
no, it's still a before and after picture going on here. So yeah, be careful. So yeah, I was
TV geezer in as the after, shall we? In the edit.
yeah, he can take your place. But anyway, yeah. So I was trading all over the place while trying to keep short in the pair and trying to make some money, and sort of improving my average. Now I'm expecting more of the same this week. But as I say, I'll definitely be looking to see whether we've broken any ranges, particularly in dollar yen, or if we remain firmly stuck in it, and because that will really guide how I trade things moving forward.
Indeed, yes. Your trading's all over the place. This segment's all over the place. Shall we move on to our plays of the day and try and restore some order?
Yeah, good luck with that.
Right, S&P 500 is where I'm looking this week. We closed at a record high towards the back end of last week. I'd actually forgotten I was going to mention seasonality here as well, just for you, Ryan. We are thus far defying that seasonality nonsense that we typically see with regards to September. I think the bull case is still a robust one. Earnings growth is solid. Economic growth is strong under the surface, although we look, of course, the retail sales print on Tuesday to ensure that remains the case. Trade tensions are cooling. Looks like the US and China have done some kind of deal on TikTok. Xi and Trump are going to speak on Friday after the Donald has had his few days of state visiting here in London. And of course, a much easier monetary policy backdrop is on the way, and that makes for a pretty potent case for the market to continue moving higher. Having said that, as we touched on earlier, the market is very, very dovish in terms of its Fed pricing, not only the path this year, but also the path back to essentially a neutral rate by the middle of next year. So it does feel like we could potentially get a bit of a knee-jerk dip on the FOMC announcement and or Powell's press conference. If we do, then I would be viewing that firmly as a buying opportunity and looking to step in. I don't think we'll get as low as it, but certainly if we were to look to test the 50-day moving average, that's a level that I think would interest many. And if we don't, then the rally is just going to keep rolling on. And in my mind, it's one where the momentum is worth just riding higher. Ryan, dollar CAD.
Yeah, but before I move on to that, I know you're baiting me, but I might have to do a topic on why seasonality is a load of old cobblers in a future show. So be prepared.
You know, I actually do genuinely agree with you on that one. I don't mind seasonality when there's a reason for it. For example, if there are, let's say large tax payments due around a certain date and people are liquidating in order to pay those, or whatever it might be, or Labor Day, there's a certain weakness here or a strength here. People are coming back after their holidays, same as at the start of the year. We're always going to see people buy into stocks at the back end of a year to window dress their portfolio, and at the start of a year because they're putting on new positions for the new trading year. I agree with you. People who are going, it's the 15th of September, and that means that gold is going to go down in a straight line for the next 3 days. Well, maybe, but also maybe not. And unless you've got a fundamental reason for that, I'd be inclined certainly to take it with a pinch of salt and most definitely not trade on that in isolation.
Well, thank you. You've just saved me from doing a topic on it because you've just done a topic on yourself. So, well done. Okay, I'll move on. I'll move on to my play of the day then. And dollar CAD, I'm looking for a bit of an outlier dip in this one. I think it's one pair that could rally after the Fed when that's all said and done. So I'm looking for a dip, maybe a bit of an ambitious dip down to the 137.20, 35 zone for a long. As I say, it might be a bit of a stretch for that one. So I'm also going to keep an eye on the confluence we got growing between the daily moving averages, the 100 and the 55, around about 137.50, 60. So that might be a consideration too. As mentioned, we do have big data ahead of both the BOC and the Fed. So who knows, we could see those levels down there. But even then, depending on where we are on Fed day, and if we haven't hit any of my levels, I still may pick up any sort of dip in this pair at market over the FOMC, and depending on what they deliver. So I'm a dip buy in this one.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. I'll be joining him with the Forex Analytics crew in about 3 hours to have another interview. So plenty more for us to discuss there. As always, thank you very much to Kyriakos, our producer, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know how you're navigating this absolute mess of a week in terms of risk events that we've got coming up, and also if there's anything you'd like us to discuss on next week's show. Not that we're going to be short of topics, I don't think, given the amount of things going on, but that is when we will be back with another episode of The Trade-Off. In the meantime, have a very good week ahead, and we'll see you then. Thanks always for watching. Goodbye for now.